This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. Happy New Year and welcome to our 2026 predictions episode. Before we talk about what's coming next, let's rewind just a bit. Last January, we made 5 predictions for 2025. So today, we're checking in to see how they played out. Starting with prediction number 1. Interest rates will edge down modestly, but not until the second half, totaling 50 to 75 basis points for the year. Dianne, how'd we do?
I'll say first of all, Alyssa, I'm so glad we're doing this because 1 year ago we made 5 predictions for the new year. We documented them in a report, and now we're going to do what meteorologists rarely do. You never see a forecaster come back after a storm prediction flops to say, sorry you bought eggs and toilet paper and milk and it never snowed. So today we're going to one-up our weather forecasters and we're going to grade ourselves on the predictions last year. So on interest rates, I'd say, Manus, we fared pretty well. The interest rate cuts did not come until the second half, September, November, and December to be exact. All 3 were modest 25 basis point cuts. Those totaled 75. So, Manus, I'd say our first prediction was a win.
I think this is a great way to start the podcast, reviewing our predictions from last year. I can only hope that we are as successful next year as we were this year. As you'll learn as we unspool this podcast, a lot of difficulty this year coming up with our predictions. So I'm looking forward to it, but really glad that we had that first one nailed down.
Prediction number 2. CRE lending will increase 25% as banks re-engage.
Well, we don't have full year commercial real estate lending metrics yet, but I will say as of Q3, the latest from the Mortgage Bankers Association was that CRE lending was up 35% year over year in Q3. So that was a bit higher than our 25%. And refi activity was at a record high. So still too early to call, but I'd say we were in the ballpark there, if a bit shy of that number.
It was one of the really pleasant surprises of last year, how liquid the markets were. We saw all 4 pillars of CRE lending really operating on 8 cylinders. And it's a funny paradox because you talk to people in certain markets, particularly multifamily, where they talk about how hard it is to get the proceeds that you want and how it's tricky to get cash out refinancings done. And sometimes that paints a picture of illiquidity, but we couldn't have asked for anything more in 2025 in terms of liquidity. It was really terrific for borrowers last year.
So if we were a little too low, we'll take it.
Prediction number 3. CRE deal-making will rebound 15 to 20% as pricing stabilizes.
Well, again, Alyssa, we don't yet have the full year data on commercial real estate transactions, but sales volumes were up 17% year to date through October. So I'd say this prediction seems to be right on the money.
It goes hand in hand with point number 2. Deals could get done because liquidity was out there for people. I hearken back to what was a great year for CMBS, the highest volume in more than 15 years. And it just goes to show that the CRE market was really functioning last year. It's shown in the lending numbers and it's shown in the deal activity numbers.
Prediction number 4. Treasury rates will be volatile, hovering around 4% by end of 2025.
Well, I think we can all agree that rates were really volatile this year, as was the market. There were a lot of twists and turns and narratives about the market, and the Treasury yields responded to that. Currently, 4.15. The high point for last year was 4.49, and that was amid rising inflation expectations. The low was in early April, around 3.85. As this flight to safety buying happened, as tariffs were making headlines. So I'd say, yeah, they hovered around 4%.
This is one I would have loved to have gotten wrong. 2 and 3 we got right, but they were happy predictions. This one I would have loved to have been wrong on. I would have loved to have seen that 10-year Treasury get down to the 3.5% level and stick there. It's been higher for longer for too long. I'm hoping that 2026 brings us back into that 3 handle, which I think would give CRE another jolt.
Prediction number 5. The LightBox CRE Activity Index will average 95 to 100 for the year.
Now, Manus, I will say that I know you had your own personal forecast here, which you can talk about in a second. This is one prediction where we were wrong, but we'll take it. The average through November was 107.1, so that was above the 95 to 100 prediction. We did have 9 months in the triple digits, though. And I will take a moment to tip my hat to CBRE's Spencer Levy here. He was our guest in early December 2024, and I think his prediction for 2025 aged well. You might remember he predicted that 2025 would be a good year, but not a banner year. And I would say with a lot of unexpected twists and turns, that's exactly how it played out.
Yes, I certainly was on the bullish side, especially when we came out of April with barely a bruise from the tariff time. I thought that that would propel us to new highs, but as you said, we'll take it. With the fact that we were up somewhere between 7 and 12% above where we expected to be, I think was a great win. If we see that continue to climb in 2026, that will be very beneficial and constructive for the whole CRE industry. But I have to say, Dianne, most of the credit here, if not all of the credit, goes to you. I think these were your predictions. And I think you put this all together last year. And I think getting 4 out of 5 over the course of 12 months correct with as much opaqueness as we had last year was a great score. And I just remember how much I longed for an 80 back in my 20s when I was taking chemistry classes in college, that, I would have died for an 80 in organic chemistry. So kudos to you for such a great 2025.
Thanks, Manus. We did have help. It wasn't just me working in isolation, but I feel like, and this is a good way to pivot to 2026's predictions, I have to say I'm not feeling as bold this year, and I think in a lot of respects, it's a little bit harder to predict where we're headed this year.
On that note, let's dive into our 2026 predictions. I want to cover them in 2 areas. First, let's talk about your predictions for the broader market on a macro level. What do you expect we'll see this year? Manus, let's start with you.
Well, I mentioned that last year was very opaque coming into the year. We were coming in with a new president with very bold expectations and predictions and plans, and that made it very hard to know what 2025 was going to look like. And for that reason, I will double down on Dianne's accuracy last year, that we came in with not a lot of visibility as to what would happen, whether Trump could get a lot of his things done, whether Congress could slow him down, how quickly his cabinet appointees could make things happen. So it wasn't easy to do. That being said, I think it might be even harder this year to get some visibility. And I spent a lot of last night thinking about how I would tee this up today. And I really felt torn, even when we hit record today, as to, am I bearish or am I bullish on 2026? So I'll try to lay out the bullish and the bearish cases and see if I could talk myself into one or the other. What do you think, Dianne?
I love that. I'm curious to see where you take it. So go ahead.
So let's talk about the potential bullish scenario. And you'll see where the opaqueness comes in. There are certain things that we know can or will happen in early 2026. The first thing is checks from the Treasury during tax season should be enormous. We know that they passed the SALT bill last year, which gave people much higher deductions for state and local income taxes. That means that refunds should be very high come April. That should give a jolt to the economy. That's probably what I would call a fact. The second thing, harder to predict, but possible, that the administration somehow finds a way to send out stimulus checks to low-income workers from the tariff collections. That too would be accretive. The third, we could have a new Fed share. That Fed share could be incredibly dovish. We could see rates really thrust lower in the first quarter or second quarter of next year. Those are real tailwinds to the U.S. economy. We saw earlier, a couple days ago, that GDP was already running hot at 4.2 or 4.3%. So that lays the groundwork for a potential bull scenario. And one thing that we do know is presidents go all in to win midterm elections. They want their legacy to be that they have held the House and the Senate and they can continue their legacy. I don't think anybody is more all in than President Trump. And that serves as my bullish case for 2026. I'll pause there, Dianne, and let you react and give your own take on that.
In preparing for today, Manus, I think I landed more in the bullish camp than the bearish camp. So I agree with much of what you said. One of the things that really stuck out in my mind as I listened to you, and also last night as I thought about the past year, is you started by talking about the lack of opacity that we had at this time last year. And, there were so many points in the past 12 months that you characterized on this pod as pearl clutching. These dramatic headlines, whether it was all the talk about Doge and the mass federal lease cancellations or the sharp uptick in prices that we would see from tariffs. I mean, those are just two of any of a number I could have mentioned. And I feel in a way that the markets have kind of adjusted to these dramatic developments. So I do think that this year there maybe will be a little less pearl clutching because we did see CRE kind of soldier on despite these dramatic headlines. So I think that's one thing that kind of feeds into my bullish take is just that the market has kind of adjusted to the fact that we're in this 24/7 news cycle and the fundamentals matter more than anything, and the headlines may or may not be alarmist, but business is business. That makes me feel, I think, pretty good about where we are in the market this year. Thinking about predictions, my thoughts did, of course, go to Chairman Powell and the fact that his term is ending this year. And I do predict that rates will move faster once he steps aside. And after years of Fed minutes using terms like pause and wait and watch the data, that we will have a new chair step in and cut rates more decisively. If I had to put a number on it, I would say we'll probably see policy rates fall quickly, potentially toward 3% by the end of the year as the Fed shifts from that kind of cautious stance to more of a course correction. What do you think? 3%?
3% would be something. I'll get into my bearish in a moment, but I want to put a bow around the bullish side of things. Shortly before Christmas, I saw on CNBC the range of where analysts from the various banks see the S&P 500 finishing a year from now. And the thing that was striking to me was at the low end, and I forget who the low end was, it might have been Bank of America, their prediction was for something like a 4% uptick by the end of 2026 for the S&P 500. And I think at the high end, maybe it was 17%, something like that, 18%. So you're really talking about a market that is, or a set of analysts that are unanimous in their bullishness. And that comes at a time after 2 successive years of 20% gains in equities. So anytime everybody is in the same camp, I do get a little bit nervous. On the other hand, Mike Hartnett, who I read, he's the chief strategist for B of A. He said, as in the past, you don't fight the Fed, you don't fight what the Fed is doing. In some ways, he said, right now, you don't fight the stimulus. We have QE2, right? The Fed is buying bonds to push interest rates lower. We could have stimulus checks. We will have higher refunds than in the past. We will have a more dovish Fed share. He said, who are we to fight this? Ride the wave. And so that concludes my bullish take on this. But I don't think that the year comes without potential headwinds, and I'll get into those in a moment.
I agree that anytime everybody's kind of in the same camp, you're thinking, well, what am I missing? I will make another prediction on the topic of interest rates. I also feel like we spent the better part of the last year or more talking about inflation, waiting for rates to come down. And I think 2026 will be, and this kind of feeds into the kind of bearish avenue that you alluded to, Manus. I think that in 2026, labor becomes the dominant story. Where in the past, we've been talking a lot about inflation. We've been talking about tariffs and the potential jolt that never really materialized. And I'm not saying that inflation will go away. I think clearly it's sticky, but I think we're seeing immigration policy that's shrinking the labor pool. In the late part of 2025, we started seeing metrics that hiring was slowing. that labor was starting, or that layoffs were starting to pick up in certain pockets, that job openings were drifting lower. And we saw unemployment rise to 4.6 in November, which is the highest it's been since 2021. So I think the labor market will be soft and stable next year, and maybe we end the year closer to 5% unemployment. But in general, there's more chatter about the labor market than about inflation.
Certainly, labor will be front and center, and you do have conflicting headwinds. If we do shrink the labor force, or we continue to see a decline in immigration and even reverse immigration, that would put a floor under people looking for jobs, right? Fewer job seekers should be beneficial. But you're right, the labor market does seem to be shaky at the moment. Hiring seems to be very lukewarm. And I do think that that will be one of the big stories of 2026. Let's get into the bear case. The bear case for me is, I'm always afraid anytime people go all in on something and that all in is stimulative, that something can break. And we saw it, recent memory tells us that in 2021 and 2022, when we went all in on ZIRP, zero interest rate policy, when we went all in on stimulus checks, deficit spending, we did see things break. We saw markets surge to levels that were unsustainable, particularly in CRE. We saw people chasing value-add multifamily properties because they could borrow at 0% or 3%. We saw homeowners buy second homes. We saw spending go through the roof, the Peloton wave, and so forth. And what I fear is, in chasing the midterm elections, that the administration goes too all in, and it just reminds us that deficit spending is bad. Our deficits are too big. We're not doing anything to reduce our overall burden of debt, and that his intentions are to lower rates, but what they end up doing is pushing rates higher. That people start to say, this is 2023 all over again. We're taking steps that will reignite inflation. We are stimulating the consumer. We are driving short-term interest rates to a point where people will chase investment returns. And at some point, there is a reckoning. And that is my bearish side for 2026, that too many bad decisions are made early in the year and we pay for it later in the year.
Well, I hope in that case you're wrong. You know what I thought of when you were speaking? Remember those rides at amusement parks? It's a giant ship that's dangling down, and it starts out slow and then it swings all the way to almost like a 360 and then back down again. And I feel like in politics, the situation is such that we're swinging to one extreme, and the midterm elections could take us to the other extreme and, to your point, cause these dramatic policy decisions. I do remember Ryan Severino when we interviewed him and we asked him to make a worst case prediction. And his worst case prediction was that we actually see rates start to go up. And I remember when he said it, I thought, oh my gosh, I haven't even thought about that, because everybody's been waiting so long for rates to start coming down. And I think if that happened, it would really be like a lightning bolt kind of hitting the market, and definitely start the narrative of the bear case that you outlined here. Hopefully that won't happen.
So I guess it's time for my macro predictions. Now that I've talked myself bearish and I've talked myself bullish, where do I think we'll be? Let's start on the interest rate side. I do think that we will see a steepening of the yield curve. I think the administration will be successful in pushing short-term rates lower. We will see more cuts as the Fed becomes more dovish and the administration has more voters, more Fed presidents making the decisions in 2026. But it would not shock me in the least if that comes at the expense of even higher for even longer. That deficit spending, an economy on fire, pushes that 10-year back up to 425, 450, maybe even we touch 475. And so it's kind of a devil's bargain, that we get the shorter term interest rates that the administration craves, but it comes at a cost. And I think that part of it is the bearish side. On the bullish side, I do think that who am I to fight the momentum that the market has seen over the last 2 years, that I think Mike Hartnett has it right, that stimulus checks, big refund checks, an administration that is talking a dovish game, that is pushing all levers to win the midterm elections. I think you're fighting against a heavy wind to go against that. So while I don't expect the S&P 500 to be up 20% again, and while I think there could be a couple of nasty sell-offs in 2026, I think low single-digit gains is probably where we come out, with most of those gains coming in the first 3 to 4 months.
That's a pretty good forecast, Manus. I don't object with much of that, except wow on the 10-year Treasury at 475. What you said isn't wrong. I think it's dependent on as you said, on the route that the next Fed chair takes and what the pace is, whether it's early in the year or later. I have to say, right now, I'm a little bit more moderate on the 10-year. I think it'll kind of, similar to last year, it'll stay in the 4% neighborhood, pulled higher maybe by deficits and issuance, maybe pulled lower if economic growth starts to slow. But I think we'll probably see it bounce around the 4 to 4.2% range.
Okay, let's move away from the broader market to get your thoughts on CRE specifically. What do you expect we'll see this year?
The things that are on my mind, just first from a broad kind of thematic standpoint, I think 2026 looks different from 2025 in the sense that last year was kind of a transition year. We were coming away from the post-peak high interest rate environment of 2023, of 2024. And we went through a change, obviously, in the presidential administration. 2026 feels like, in terms of sentiment, that it's kind of shaping up to be a year of more action, of more intention, of less of kind of a wait and see mindset. So think more like pressing the gas pedal than tapping the brakes. And I think some of the reason I feel that way, Manus, is because of what you opened with, which is there's more visibility now in terms of where we're headed with rates, with property pricing, on where value actually sits. A year ago, appraisers were struggling because they didn't have a lot of sales comps on a property, and they have so much more now because we're coming off a year of healthier CRE transactions, and we're seeing more stabilization in property prices. We're not seeing those wild kind of double-digit swings in pricing indices that we saw over the past couple of years. So I think it's more of a year of intentionally placing capital than saying, well, let's just wait and see where things head. What do you think?
I think 2026 will bring more of the same for CRE, and that is mostly a good thing, but not entirely a good thing. So let me peel the onion back on this. Now, we talked about before how lending volume was up, liquidity was really plentiful last year, and transaction volume was up. And I think that for 75% of the CRE market, they look back on 2025 and say, I'll take it. I was more busy than I was in 2023, 2024. I found some opportunities. I originated more loans. I made a little bit more money. It was a great thing. But there was 25% of the market that I think was left behind. People that bought properties in 2022 were still working things out. We're still trying to extend loans. We're still trying to avoid cash-in refinancings. They still had buyer's remorse from those years. So I ran into too many people in the fourth quarter that were talking about how it's still a slog, how they're still working out distressed assets, how rent growth in multifamily has been so halting. So I think by and large, 2025 was a very good year, but there was a segment of the market that was disappointed by the higher for longer element and the fact that we didn't see rent growth. And I do see that bifurcation continuing in 2026. So what does that mean? If I'm following through on my predictions for the macro level and I say that we're going to see shorter rates come down hard, then I do think for those that are trying to find new properties, have cheaper capital available at the short end, that buying properties will accelerate in 2026. We'll see more buying. We'll see people stretching a little bit more, which, as long as it doesn't turn into a mania like it did in 2022, as long as people don't repeat their mistakes and chase returns and load up on floating rate low short interest rate debt, then I think we come out of this feeling pretty good on that side of the market. And we do see that LightBox index continue to march higher month after month. But I do think the have-nots that we had in 2025 remain in 2026. And why would that be? If I'm saying that the 10-year hovers in that 425, 450, 475 range, then what I'm really saying is those people who have been trying to muddle through over the last 2 years are still muddling through. They're still waiting for that 3.5% 10-year Treasury to bail them out. And if that doesn't come, then that slow grind of dealing with the problems of the irrational exuberance of 2022 just linger on. I'd love to hear your thoughts.
Yeah, you anticipated where I was going to take this next, Manus, which is thinking about my forecast for the LightBox CRE Activity Index. My prediction is that 2026 should bring steadier, more durable momentum. I think we'll see triple-digit readings become more of the norm, but that peak activity is going to edge above where we were last year, maybe by inches, but not leaps. And I think it's because of the things that you just talked about. Some will dive in kind of emboldened by lower rates, ready to jump in more so than they were in 2025. But others, the have-nots, as you called them, will still hold back a bit. So I think the average maybe settles around 110 to 115 compared to 107 in 2025. And I think that will be the sign of a market that's better aligned, but it's not overheating. You know, I think there's a bifurcated market, as you mentioned. We did see institutional investors come back last year. Now we're seeing some private capital funds announce that they feel like they're underallocated to commercial real estate. So maybe they're the first ones to kind of dip their toes back in the water this year. But others, to your point, who've been trying to muddle through, they're going to hold back a little bit. And so that will be kind of a buffer on outlandish growth. And that's not necessarily a bad thing. It's a sign of a market that will progress slowly and cautiously and not overheat in the way that we saw in 2022.
I think there are two wild cards that potentially could mess with, our narrative here. One is if the all-in and the stimulus checks come to pass and the tax refunds come in enormous, does that trigger a new round of consumer spending like it did during COVID, where people are just all in, pay for that higher level apartment, reach for the bigger vacation, spend more readily? If that were to happen, I think maybe that bails out some people in the multifamily segment. Maybe people in retail say, wow, this was a great year. People are back to spending. That would be a positive for the U.S. economy. On the other hand, you pointed this out before, people are very cautious right now. The job market is really operating on 3.5 cylinders, 4 cylinders. It's not going gangbusters. And if that weighs on people throughout 2026, that would be a net negative for the CRE market. If people are pulling back, not spending on retail, not spending on travel, not spending on maybe a slightly better apartment, putting downward pressure on rents, all of that would work to the detriment of CRE investors and lenders.
Agreed. And I think you're right on the money there. And the other thing that I keep hearing from investors I'm speaking to and other clients of LightBox across the board is a theme that we've talked about on the podcast before, which is it's kind of like a back to basics in commercial real estate, where if prices aren't appreciating like crazy, then where does that leave investors? It leaves them thinking, where will I get the highest returns on my investment? What can I do to increase the income on this property? How can I improve the tenant experience? How can I manage this asset better? How can I attract reliable tenants? So they're not relying on price appreciation so much as maybe improving the property and looking across the spectrum of asset classes and thinking, will I get more bang for my buck if I invest on this multifamily property in a population center than to the extreme, a central business district office? And I think for folks in commercial real estate, especially those who maybe have been through a couple cycles before, it's really a return to basic property management in a way that they didn't have to in 2022 when prices were going up like crazy.
Okay, Manus and Dianne, I have one more question for you before we close. If you had to make one surprise prediction for 2026, what would it be?
Well, in typical Manus form, I can't limit myself to one prediction. I will channel Byron Wien, who I think worked for Morgan Stanley most of his career. And at the end, he was at BlackRock. Every year he would come out with 10 outlandish predictions. And his modus operandi were things where the market would be saying there's 0% of this happening, yet he would say, no, there's a 40% chance that something like this could happen. And they were great reads. He did them for years and years and years, and it really made you think. I wish I had his creativity in terms of coming up with things. So I'll come up with two here. The first is, I do think that the U.S. equity markets will see a nasty, nasty sell-off sometime in the first half of the year, led by tech, with people coming to grips with the notion that tech spending is just way too high, that the returns of AI are way too distant. And having seen crypto sell off by more than 30%, I see what can happen to markets that are overly exuberant. And so I will say at some point in the first half of the year, we will see a NASDAQ sell-off of more than 20%, which will jar the markets. That would be one. The other, and I do this really every year, I will say that this is the year that the New York Giants figure it out, that they shock the world and go from 2-15 to a NFL semifinalist next year and shock the world. I'm not calling for a Super Bowl victory just yet, but 2026 becomes the New York Giants renaissance.
Hope springs eternal, Manus. I will say that the equity market sell-off was an interesting one, and we certainly saw early signs of how that could materialize late in 2025. So you might be right there. That could be our first pearl-clutching moment of 2026. I will say no comment on your Giants forecast. I personally watched the Super Bowl for the halftime show, so this year I'll be looking for Bad Bunny. But for my outlandish prediction, AI is top of mind for me because we just closed the first LightBox survey on AI adoption. It was in the environmental due diligence sector, and in that segment, 47% of respondents are using AI. Only 19% are using it daily. So when I was thinking about a surprise prediction, I think by this time next year, everyone in commercial real estate will have at least one task that they do today that is no longer done by a human, but by AI. And I don't mean typing a prompt into ChatGPT. I mean AI embedded directly into workflows. You know, and I'm old enough, Manus. I remember my first job at a consulting firm outside of DC, copying reports, binding them, rushing them to FedEx, way before PDFs, way before the internet. And I think what's different now is just the exponential speed of adoption that's happening faster than any other technology shift that we've seen before. So my surprise prediction in 2026 is that something that you do today will be done by AI 1 year from now. So I hope that our loyal listeners had a wonderful holiday season. 2026 is officially underway, and on behalf of the entire staff of the CRE Weekly Digest, I'd just like to take a moment to thank our listeners for their input, for their loyalty, for their thoughts, and wish all of you a prosperous new year.
Thank you to our producers at Bruning Media. Join the LightBox team every week as they share CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.